Any day now. Go back over here and make sure. Yep, that is connected. All right, it seems to be up. Let's make sure we have the volume. Sure. Yep, there is the volume right there. Let's go. All right, guys. Big. Well, a text here. Just, notepad. I want to take the time to talk about something very serious. I'm also all about transparency. In no way am I a financial advisor, but the fact of the matter is, anytime you share stuff on YouTube and you're showing people what you're doing, eventually some people start doing what you're doing. And you can tell them all day long, don't do it. Don't do what I do. People going to people, okay? Especially if the account starts doing good, things start looking right. People are like, ooh, numbers go up. Of course, they're going to try what you're trying. But I got to be clear. I showed previously a big mistake I'd made with Camber Energy, and we're going to go over that. So this video is, learn from my mistakes. Because I don't want to sit here and be like, oh, all I ever do is win. I had a very good dividend account. I had a so-so Robinhood account. Different points in my life, I cashed those accounts out for different reasons. Then I went back and tried again because I wanted to learn options trading and do it my way and yada yada. So, top line, learn from my mistakes. I'm going to paint the scene for you real quick. I had 500 in the account. I had the idea to learn options trading. I found out the very low cost stocks, the premiums were not very good, and the strikes were just huge gaps. Like we're sitting at $1.50, and you're like, you can choose $1 or you could choose $2.50, and I'm like, oh, no, those gaps are way too big. So I bought into CEI. CEI was kind of cheap. I think at the time, we may have even started Camber off at $300. It may have been a $3 stock at the time I got in. With the idea that I was going to options. Then I looked at the options. I think I did like 1 or 2 options. And I was like, oh my God, this is horrible. No. How can I speed this up? How can I speed this up? How can we accelerate? Oh, well, I'm going to switch this to day trading or swing trading. Now, you can't really day trade on small accounts because you're only allowed so many trades. But I only needed 3 to 5 trades. I didn't need a lot to really make this work. So we were going to give it a shot. Price goes up 5 cents to 10 cents, sell. Price goes back down to where I was or lower, buy. And in simplistic terms, this is a solid plan. What we're told. Buy low, sell high. That's literally what I'm trying to do time and time again. Each sell nets more money, so each buy at the previous lower strike gains more shares. More shares increases the value of each gain. Nothing wrong with the concept. You snowball, you compound. You're literally compounding. You just have to keep getting it right. I made 3 major mistakes, and really a 4th, so let's go over them. These mistakes are not limited to options or day swing trading. These are universal mistakes, so let's learn from them, let's improve together. Mistake number 1. Rule number 1 for selling a call is you don't sell a call on a stock you don't want to own. If you sell a call and you get assigned those shares and you go, oh, God, what have I done? You should have never sold that call. When you're talking about calls, you said these were universals. Never buy a stock you don't want to own. It's that simple. So with calls, the premium is actually secondary. Yeah, we like the premium's nice, but over time, the idea is that we want to be called because we want the stock. We just want the stock on our terms, at our price. Not what it is now, but something more beneficial to us in the future. And if we never get it at our price, the trade-off is we keep getting our premium. While we have, and the opportunity cost is the money for that is just constantly locked up, right? You can't use that money. It's being used for this. So there's an opportunity cost as well. So whether investing or trading, we want good stocks. And I didn't actually want CEI, but for some dumb reason, I had an entire strategy that required consistently buying CEI. Mistake number 2. I did not set up a stop loss, whether mechanical, within the platform, or mentally, and applied manually. Boom. Let's fix that. What is a stop loss, real quick? Well, a stop loss is, hey, I'm going to buy the stock of this, but I'm going to set up something. And a lot of platforms let you do this mechanically within the platform. You can also keep tabs of it mentally, but then you have to go and manually execute the trade. I bought at 10. If this thing craters down to 5, I'm not holding. I'm getting out. Now, I might buy the dip at 8, but if it goes down to 5, we're just selling and getting out of the position. That's a stop loss, okay? Usually you'll hear the term referencing the mechanical variation within a platform. You can mentally stop loss. You just have to be there in real time to execute the trade. It is much safer, much more efficient to utilize the actual mechanical that the platforms are offering you. It's a good tool. We should use the tools we're given. Okay. I even bought the dip. What is buying the dip? Price goes down. If we liked it at 10, we love it at 8. Buy. Why? Because now, let's say I put 500 in at 10. It drops to 8. I put 500 in. My cost on average now is 9. I don't need it to go all the way back up to 10. I just need to get back above 9 now. So it makes the swings we need better. And it's huge on dividend investing because you have the dividend yield, but you also have the yield on cost. All right. Exxon is rocking like a 4.5, 5, maybe 6% yield. Back when I bought Exxon, I had it at a 9% yield because I caught it at its low. Beautiful, glorious moment when markets are going down, so you get all these blue chip stocks for cheap. That's when you want to, yeah, that's what you're looking for. So I was primed in a position and actually had some money, and I bought a good amount for a poor broke boy like me of Exxon, and had it sitting at a rather high yield. And Exxon held firm. They either didn't cut their rates or didn't cut their rates a lot, and now their rates are consistent and better than they've ever been. And everybody who's buying now is getting it at the current rate, and my yield on cost was 2-3 times what they're getting. So, buying the dip is actually a good strategy. You don't buy the dip to the floor. All right? So, every successful account, whether a dividend investing or a trading account, has bought dips. It's a very standard practice. I don't want you to think, oh, I even bought the dip. Buying dip is bad. No, buying dip is good. But buying dip and stop loss kind of go together. At some point, the stock is cratering too much. And you either stop buying and you sell to get out of the position, or if it's not a very large part of your portfolio, maybe you keep and say, hey, if it goes to zero, it goes to zero. If it goes back up, though, I'll be good on the hold. But what you don't do is take a big position and hold to zero. Get out and then take that money and do something else with it. So I bought the dip on a stock that I didn't even want to own in the first place. So mistake 1, buying a stock I didn't want, compounded with mistake 2, not setting a stop loss. Even buying the dip, had I a stop loss, I would have mitigated huge losses. I would have only lost 10% or 30% or even 75% instead of 100%. From any of those other rates, I could slowly rebuild. You can't rebuild from 0%. What's mistake number 3? I had 100% of my account in the deal. Big fucking no. I get in the very early days of an account, you might start with a single stock to build up enough of it to matter. No one wants 1,000th of X and 1,000th of Y and 1,000th of Z. It feels really meaningless. If you can only start with like 500 or 100, sometimes buying one thing in a block, and then the next time you can deposit, putting it all into something else, and investment by investment, growing your core group is the plan, instead of buying 5 stocks at $20 each. As an example, we saw that I had $200 into YBTC, I had $20 into RDTE, and that $20 was kind of meaningless. You don't want 5 different stocks at $20 each. You would rather $100 into a stock. And then next week, well, what was the other stock that I liked? Well, let's get $100 worth of it. Or next month, whatever your dividend, whatever your investment deposit schedule is. Damn. All right. Now that we bumbled over those words, that said, once you have a position, oh, I got 2 shares, 5 shares, 10 shares, whatever. I got $100 into this stock, 205, whatever it is that you now feel, okay, this is substantial, this means something. Now it's time to get positions, plural. You got to spread that shit out. And this is even more important when you're doing higher risk things like options or day swing trading. If I had my investments split up, my potential gains from CEI would have been lower, but so would my potential losses, and the account would survive and operate. Okay, so we've had buying a stock I didn't want, not setting a stop loss, and having 100% of my account in the deal climb. You can't possibly have more mistakes than that. That is like trifecta, hat trick. That is the formula for blowing up an account, man. How could you have possibly made another mistake? I didn't do any real research. I sought out something super cheap that had weekly options, and I was off to the races. This compounded literally every other mistake, and it all added up into a sickening, awful implosion. So those were the 3 main mistakes and the bonus mistakes. Well, let's get into why I'm making this video. For me, because I've told you there were times in my life when I was in the Army, stuff like that, when I had the discretionary income to be able to invest and trade, and I wasn't living exactly check to check. Even if I was overspending and making things tighter than it should have been, I had the money. This was a time in my life after a move, after liquidating the account, after using all of that to pay for everything that I needed up front. And the calculations, the bills were just higher than I thought. So now I'm living on like 100 to 200 a month, and it's really tough. And I'm in a desperate situation, and I'm not liking things. So I went risky. Okay, we're going to start putting money in it every opportunity, every little bit. And I put money into the account that I really couldn't afford to lose. Same thing for gambling. In fact, what I did here was basically gambling. I just gambled with the stock market this time. You know, guys, rule number 1 of anything is you never put up more than you can afford to lose. At that point in time, I really couldn't afford to invest. And I certainly couldn't afford to be risky. Yet I made that stupid choice, and I did it anyways. And I own that. That's on me. Nobody influenced me. I did it myself. Bad choice by me. But remember, it's not the mistakes we make. It's the lessons we learn from them. All right? That's important. You learn. I'm going to get a little dark here. In this moment, I showed you the Camber trade previously. I lost $1,300 total because I kept putting in, kept doubling down, chasing bad money with good, and it all went to nothing. Okay? And $1,300 for a lot of people and a lot of accounts is nothing. But for some of us, $1,300 is 3, 4, 5 months of the little bit we had left over being scraped together to try to do something. And it's a lot of money. It can be a lot of money. And for me at this time, it was so much money. All right? Now, it's this moment when something like this happens. You've grabbed what money you could, you've thrown in the account, and now you've YOLO'd it into the void. That some people who just wanted a little better in life, in their life. I wasn't suicidal myself. I mean, I had 2 tours in Iraq. There really can be something to the "if it does not kill you, it makes you stronger" mantra. I just knew I screwed up, and sucky life was going to be even suckier because I just blew over 1,000 when I only really had 100 or 200 left over every month. I'm out of that situation now. Moved in with a friend, let some things go, reorganized other things. I have plenty every month now, despite only getting about $19.50 a month. Hopefully this paid internship happens for me this month. That would be great. But despite only getting, less than $24,000 a year, poverty range, my bills are like $800 to $900 total now. I'm I'm good. I've got like 1,000 at the end of every month that I can do stuff with. That's so much better than 100. I'm good. But what I'm saying is blowing up an account like I did in a scenario like I was existing in, that can be the thing that does not make you stronger. It can be the thing that does kill you. I say this because I want to be an ambassador. I believe we're not taught as much about how to get ahead in life in school. I believe most people are financially illiterate. And I believe a lot of us stay poor because we were never taught anything else. And I want us to have hope. I want us to improve. I want us to transcend, even if it's just by a single step, from poverty to above poverty, from above poverty to that lower middle class. I'm from living paycheck to paycheck to living that same paycheck to paycheck, but now with a little investing to have something when you retire, just something more. And being able to step back and explain how you got from there to here, from worse to better, so that those you care about can learn from you, your mistakes and successes, so they can do the same. But we have to understand this. This is serious. And that mistakes can be made. And that for those with no hope and desperation, it can be the final straw. We're not here to TikTok invest or whatever, to YOLO. And I know that sounds insane when 9 of my holdings are all risky. 9 of my 9 holdings are all high-risk holdings. I'm well aware. I've explained this to y'all. You're going to see this account transform over time. I am 45 years old. I've had a successful account before over on M1 Finance with a pure dividend account. I've had a break-even account here on Robinhood that I came back to later and blew up trying risky and dumb things. The point I'm making is, my window is like 15 years until I'm 60. I'm not 18, but 42 years for this stuff to build up. So on my front end, I have to be a little more risky to start getting those payments so they can compound with my consistent deposits, so they can enhance my monthly buying power. I'm only doing this to somewhere between 2,000 and 3,000. Because the returns are so extreme, I don't have to go further than that. Because at 2K, the annual income expected is over 1,200, which gives me about 100 more a month than my deposits. And that adds up. There is a plan, and that plan is not just highest yields until the grave. I've already stated before, if I had 10K up front, this portfolio would look vastly different. I don't. And so I have choices to be made. I can go safer and much slower on the first steps, or I can accelerate short term and then pivot once my engine is built. We're going with the latter. We're building a high-risk engine and then pivoting to stabilizers. And we're doing this when I can afford it, when I have the extra money to be able to put in. So if you're here for the YOLO approach, this isn't going to be the channel for you, because I need people to understand things can go wrong, and we need to take this seriously. I want good things for myself and for y'all. And taking a permanent solution to a temporary problem because we didn't understand or respect the risk isn't good for any of us. Alright guys, I just had a migraine earlier, so I went to bed like 7. So now here I am, up earlier than I normally would be. And I felt this was an important topic. And I'm all about transparency. I haven't hid the Camber trade or anything. The video is still up on this channel from when it happened, right before the drop. I wasn't trying to dodge or shirk responsibility at that time. I was literally living at $100 to $200 left over every month, and then that's groceries. I don't mean after groceries. I mean that's buying the groceries, guys. So I just wasn't streaming. I was just in a bad way, right? But I've never taken it down. I've never hid the fact that I fucked up the account. I did. That's on me. And I think that too many influencers or YouTubers, and especially TikTokers, where the format is so short form versus long form, where you can give the nuance and explain things, It's all about YOLO. It's all about quick. There's a place for that. And even really good, really rich people with really nice accounts, if they just want a little extra, they could even put a couple of stocks like this at like maybe 1% or 0.5% of their account value and get a little nice bump on their returns monthly. Because the other stuff should be good. They should be appreciating in value on those. So, one that's depreciating but giving you huge payments isn't going to be that bad, especially when it's weighted properly, right? There are places for these tools, is what I'm saying. How my account looks right now is an extreme situation that just is going to allow people to accelerate quicker in the beginning. But you have to understand, this is not the account. This is not what the account needs to look like in 6 months when the account is at $3,000, $4,000, $5,000 valuation. There needs to be more. There needs to be stabilizers in this account, and then those stabilizers need to grow and get weighted higher than the risk. Okay. So I don't want this YOLO concept. This was never intended to be a YOLO. The plan was always, we're going to pivot, and I said that in the first video, but it's just very important because I want people doing things to the best of their ability. Sometimes you have to throw a curveball, you have to think outside the box, but it can't be the whole thing, right? So we are breaking trends here. We're doing something a little different, despite the fact being that I still want this to be a dividend account that actually grows over time. And I'm going to tell y'all, you wouldn't get that with just these 9 stocks if this is all you ever did. Eventually, most of these, the NAV beats the total return. And you end up barely breaking even or at a loss. Now, 1 or 2 of these actually look pretty decent on the long-term forecast. They're not going to be the huge 138% return because of the erosion, but they're going to be 10, 15, maybe even 20% over a long period of time. So those would still be kind of good, right? But most of these, if you're looking, aren't going to end that way, fellas. We're living in this moment to get the returns now, understanding that these stocks have to be replaced over time. Most of them. Like I said, there are 1 or 2 that are probably will be able to keep. But I don't have to transition out of these stocks anytime soon. I can keep these stocks for maybe a year, possibly more, while I'm building up the stabilizers around it, and then I can take out the most risky pieces as needed. Just understand, guys, we're not here to YOLO. I don't want any of you taking your last 1,000 and saying, yo, I'm gonna buy a call and we're just gonna roll with it. No, don't. Please have a plan that hopefully doesn't suck too bad, that you can survive if it goes bad, and just let's build. All right. So it's 5 a.m. guys. Market's gonna be open in a little bit. We're on the overnight. We will take a quick look. Remember, we were down like 1.5% or something. Overnight has been kind to us. Pre-market has been flat. Remember, 1,120 is what we put in. So instead of being down at 1,110 as we were when the market closed, we are like basically right back in alignment. We're good again. The buying the dip on Misty, which was 2 stages, instead of being down like 7, we're down less than 6. Maxi's lost a chunk too, being down around 5. That's a little rough. Coney though, Coney is big swinging. Good job, Coney. And then there was one more. Let me just look real quick. Let me bring Snowball up. Snowball portfolio. Now I've let this video get like long-winded, and I'm not just on what I came in on, but I wanted to show analytics. I got my thing all nice and set up, and then I want to show sold. Let's pull it back over here. We've got $1,121.79 value is slightly off from the update. We know that I put 1,120, which means previous all time in this account. There was another $1,444 or so invested. Hoof, guys. 1446. Might have been a good year, but it was not a good loss. All right. Well, what the hell, guy? Huh? Well, I told you, Camber Energy. All right. Oh yeah, look, see, we had greens. We had some, decent downs. Oh, 60 cents. Yeah, we recovered that. $1.07. We did good on that. But it's right here, man. Camber Energy. This is what blew up the account. This was the dumb shit I was trying. Didn't do real good with Remark either. But as you see, Remark, much smaller fucking number. I didn't make as many mistakes with Remark. I made all the mistakes with Camber Energy. Don't do this. At worst, limit yourself to how I did with Remark. Oh, I tried something, but I didn't compound all the mistakes, so I survived. I did not survive Camber. Camber killed the account, and Camber killed the account at the worst time possible. All right? I need people to see it. I need people to understand this is real money. This is not a fake account. I fucked up. You can fuck up. It is possible. So let's follow the fucking rules to mitigate shit like this so that this doesn't happen to you. Take a Remark loss. That's fucking fine. You can bounce back from that. Don't do this dumb Camber shit idea. That's the whole point of the video. I've been talking about this for like 15 minutes now, guys. I just want people to understand. Let me see. See, like Maine's not risky. I'm not trying to say Maine's a risky stock, but what I wanted to point out here, like, received $7.24 in dividends. We lost $3.45 total on it. Okay. Because when we sold, we were down $10.69. This is okay-ish. This isn't bad. If I hadn't sold out of my account at that time, Maine would probably be up for me pretty good. But the point I'm making is, with these high yields that we're doing, like this Roundtree, the idea is that you get paid a lot up front and accelerated, that it beats what you're going to have to profit and loss sell at, and that you get this money out into good quality stocks during that time before these two things meet. So if what RDTE allows me to do is get more money up front into something else during that time, then it served its purpose. It's done what I need the tool to do, okay? That's why I was a big OXLC investor. I held a lot of OXLC because that was like an 18% rate. It was beautiful. And OXLC is the reason I could buy stocks like ERM. Is the reason I could buy stocks like Cedar Fair, okay? But anyways, and VYM. See, I don't hate funds. I do funds too. We're not there yet, but we will be getting funds in here. I do stuff like that. It's all here. But anyways, guys, I got off on a tangent there. I just want people to take it serious. This is not a YOLO stock channel. I do not want you to be a YOLO gambler. Okay. Let's have a plan. Let's work on consistent growth. But that's it. It's been fun. It's even been real fun. This is a climb to one. Signing off. It always cuts off my signing off, so I'm going to ramble a little longer. I want to hear my damn catchphrase.